One mall like this once stood nearly full. Within 20 years, it was rubble. So you want to buy a shopping mall? A big empty building, filled with stores. Rent checks rolling in every month. Hundreds of shoppers walking past your stores daily. Every one of them paying just to stand there. It sounds simple, honestly. It is not simple at all. This is one of the strangest stories in real estate. Before you make a dollar, you have to survive buying the thing. A large regional mall is not a small purchase. Building one from scratch, with parking, plumbing, electrical, climate control, and permits, can run into the hundreds of millions before a single store opens. The land alone can cost tens of millions. By the time the ribbon gets cut, you could have spent more than the price of a small hospital. Buying an existing mall is usually cheaper. But not all malls are the same mall. A Class A mall has a luxury anchor, high sales per square foot, and a waiting list of brands. Those trade for enormous sums, sometimes over $1 billion. Then there are the malls 2 or 3 tiers down, older buildings, weaker anchors, poorer neighborhoods nearby. One mall in Denton, Ohio, called Meadowbrook Commons, sold for $2.75 million in the early 2000s. Far below the $33 million the previous owner had paid. A mall with over 140 stores eventually sold again for under $2 million, and kept losing tenants after that. So here's the first thing nobody tells you. You're not buying a building. You're buying a bet on a neighborhood, and the price tag tells you which bet you're making. Most mall owners today don't own them like a house. They own them through a real estate investment trust, a company legally required to pay out nearly all its profit to shareholders in exchange for skipping corporate tax. This is why large-scale mall ownership exists in its current form. Ordinary investors can buy shares in a mall-owning trust for the price of a cup of coffee. The biggest of these companies own over 100 shopping centers at once, spreading the risk across a huge portfolio. A very different game than a private buyer betting everything on one building in one town. Say you've bought your mall. Before you collect a single check, hidden costs catch almost every new owner off guard. First, the anchor leases you inherit, often signed decades ago for shockingly low rent, and you can't renegotiate for years. Second, deferred maintenance. Roofs leak. HVAC systems covering 1 million square feet wear out. Parking lots crack, and you find out about it the first winter you own the place. Third, co-tenancy clauses buried in nearly every lease. If a major anchor closes, smaller stores nearby are allowed to pay reduced rent or walk away entirely. You don't see this cost the day you buy the mall. You see it the day your anchor leaves. 1. How a mall makes money. Here's where it gets interesting, because mall income comes in layers. The first layer is base rent, a fixed amount per square foot. A small specialty store might pay $40 to $60 per square foot, while an anchor pays a tiny fraction of that, sometimes only around $5. Why would an owner accept that? Because the anchor isn't paying for space. It's paying for its name. So every smaller tenant is quietly subsidizing that discount. The second layer is percentage rent, extra money tied to sales above a set breakpoint. If a store's breakpoint is $1.5 million a year and it sells $2 million, the mall might take 6 or 7% of that extra $500,000. Income that scales automatically with performance. The third layer is common area maintenance, tenants paying their share of cleaning, lighting, security, and upkeep based on how much space they occupy. The fourth layer is everything that isn't a store: parking fees, digital ad screens, kiosks, and holiday pop events. A tiny kiosk selling sunglasses in a busy walkway can be priced far higher per square foot than a full-sized store along the wall, because it sits directly in the path of every shopper passing through. Size and rent, in other words, are not the same thing in this business. Position is worth more than space. Quick favor before we keep going. If this is opening your eyes to how strange mall economics really are, hit like so more people see it. Drop a comment telling me whether you'd ever bet your own money on a struggling mall like Meadowbrook Commons, or whether the risk feels too hidden to touch. And subscribe, because we're about to walk through exactly how a nearly full building like this one quietly collapses into rubble. Now the other side of the ledger. Utilities on a 1 million square foot building are enormous. Alongside security, cleaning, landscaping, and constant repairs. Property tax and insurance keep climbing every year. And here's the trap hiding in the common area costs. They don't shrink just because stores sit empty. Hallways still need cleaning. Lights above vacant storefronts still burn. Security still patrols the whole building. So rising vacancy raises the shared bill for every remaining tenant, pushing marginal tenants to leave too. Even a mostly full mall can lose money if the mix is wrong. A mall at 90% occupied might look healthy, but if half that space is anchors paying next to nothing, and the rest are discounted short-term leases just keeping lights on, real cash flow is far weaker than it looks. Occupancy is not income. The man credited with designing the modern mall was a developer named Walter Kessler. He studied how people move through buildings and spaced anchors apart by roughly 3 city blocks, so shoppers walking between them would pass dozens of smaller shops. He placed escalators at the ends of hallways, not the middle, forcing people to walk the full length of the corridor. Every choice maximized the storefront. A shopper's eyes would pass before reaching what they came for. Now the structural risk. For most of the last century, department stores like Kendrick's were the backbone of the mall, the reason developers could even get financing. But starting in the 2000s, those anchors began closing fast. When Kendrick's filed for bankruptcy, its stores sat inside dozens of regional malls, and one closure could trigger co-tenancy clauses across the entire building. A wave of rent cuts affecting dozens of stores at once. Refilling that empty anchor box isn't simple either, since these spaces were built for one specific kind of tenant, with layouts that don't easily convert. 2. The rise and fall of Meadowbrook Commons. Meadowbrook Commons lived through both versions of this story. It opened with Kendrick's as its first anchor, grew to over 140 stores, and was once 98% occupied. Then, a newer mall opened nearby. Anchors relocated or closed, and by 2006 it sold for $1.6 million, a building once worth over $30 million. It closed for good a few years later. Scrappers stripped its copper, rain poured through broken skylights, and the city eventually seized it for unpaid taxes. It was demolished in stages, and a logistics warehouse now sits on the land. All of this happened alongside online shopping, eating into retail spending. The mall's whole reason for existing was convenience, comparing brands in one trip, and the internet broke that monopoly completely. The malls that survived changed what they sold, filling old anchor boxes with restaurants, gyms, clinics, and entertainment. Things a screen simply cannot replace. So does owning a mall actually work? It depends entirely on which mall. In the best case, strong anchors, low vacancy, and a healthy tenant mix produce steady income for decades. In the realistic bad case, one anchor leaves, co-tenancy clauses trigger, and fixed costs get spread across fewer paying tenants until the building slides toward the same ending as Meadowbrook Commons. The building never changes. The economics underneath it do. A mall looks from the outside like a building full of stores, but underneath, it's one tightly interconnected financial system, where every tenant's fortune quietly depends on the tenant next door, whether they realize it or not. The anchor doesn't just sell appliances or furniture. It sells the foot traffic every smaller store depends on to survive. And when it leaves, it doesn't just leave a hole in the floor plan, it pulls the financial floor out from under everyone standing near it. The building was never really the business. The people walking through it always were.